My name is Hari Krishnan. I'm a fund manager at Doherty Advisors, and I've been on this station before talking about ETFs and dangers in the VIX and the VIX markets. It's a pleasure to introduce Vasant Dhar, who is a founder of SCT Capital, one of the first machine learning hedge funds in existence, a professor at the Stern School of Business at NYU, and a director of the PhD program in the Center for Data Science, also at NYU. It would be interesting for me, at least, to know how you got started in machine learning and how you got started in finance, two apparently disparate areas, at least back in the day.
Yeah, well, great to be here, Hari. Great to be having this conversation. So strangely enough, I got into machine learning because of Nielsen, the media company. And they have a household division, and they were tracking lots of households and what they were purchasing. And they gave me this data and said, can you find some interesting patterns in it? This was like 1990. And I said, to what end? And they said, well, we'd like to do we'd like to know how new products do, what products do well, what their selling patterns are. So, I went off for a few weeks, and we had a meeting, and they said, so, Vasant, what'd you find? And I said, I found lots of things, but I can't explain them, such as, a lot of older women in the Northeast shop on Thursdays. And they said, yeah, that's coupon day. What else did you find? And I was really excited because I hadn't actually told the machine to look for any such thing, but there were reasons behind the patterns that we found. And that just led to more interesting stuff in the data. And so I became sort of a believer in these machine learning methods because they seem to be finding interesting stuff. And then fast forward 3 years, I was introduced to a gentleman called Kevin Parker, who'd been appointed by John Mack, who was running Morgan Stanley at the time, to run tech. And Kevin was a big believer in technology, and he brought me in to implement machine learning at Morgan Stanley. So I think I sort of brought machine learning to Wall Street in the mid-90s. And the two problems we were looking at was customer data and then financial market prediction. So I did both of those things and gravitated towards the market prediction side of things. And if you know anything about proprietary trading groups, they want to know everything you know, but they don't want to tell you anything they know. So I proposed a simple experiment to them. I said, just give me all the trades you've done in the last few years, and I'll tell you if you could have done better. And they said, you don't need to know anything about the strategy. I was like, no. So I took the trades, and I did some hocus pocus, let's call it. But I literally sort of amended the trades with market state information, and I cranked this genetic rule learning algorithm I'd been working on. At that time, the tools were far and few between, and you had to build your own. And it came up with these patterns. And I remember I went to the first trading meeting, and it was the same sort of deja vu, all over again. Kevin saying, so Vasant, what'd you find? And I said, I found a bunch of things, but I'm not sure what they mean. He said, all right, take it from the top. And I said, well, when the 30-day volatility is in the lowest quartile, your trades are 3 times as profitable as they are otherwise. And, there was sort of silence around the room for a little while, and then they tried to digest the implications of it and started sort of talking to each other. And I was just watching this, and I said, can someone tell me what's going on? And they said, not really, but we've felt that we lose a lot of money when volatility spikes. So it's interesting that you're telling us that volatility actually matters. Now, the interesting thing about that incident was that I only learned the reasons for why I discovered the pattern much later, right? And so that was kind of the first lesson, which is that when you have this sort of data-driven approach to life, you find that patterns often emerge before the reasons for them become apparent.
So let me ask a quick question there, which is, if, let's say I've been trading for 20 years, am I better off bringing in a machine learning expert who's never traded, who might find some unbiased, as you might put them, structure in the data, than bringing somebody in who actually knows a lot about finance and might have certain prior expectations that
right.
might be valid, might push them in a certain direction?
Great question. Now, remember, the space I got started was I didn't actually come up with the strategy. Right? The strategy already existed, which is what you're saying. You've been trading for 20 years, you've got a strategy, and you bring someone in, right? Now, when you bring someone in, they're going to analyze your strategy, but they're not going to actually develop it. They'll analyze it, and they'll tell you if you could have improved it. And that was what I really did. So it was an easier problem that I started with than, let's say, building my own strategy, which was the next step, right? So what they said was, hey, that's interesting. Do you think you can get the machine to discover new strategies? And I said, sure, in principle, that should be possible. And that's what led me down this path to where I am, since that time. It was initially an improvement, an overlay on an existing strategy, but I didn't need to know anything. I needed to know machine learning to do that. And I needed to apply the method, the scientific method correctly, but I didn't have to do anything creative, right? The machine did the heavy lifting for me after I told it sort of what I thought might actually distinguish, good trades from bad trades. It could then find that for me, but I did very little. I just told it, consider volatility, consider trend, consider stochastics, like the usual thing, and it found that for me. But it's a completely different ball game when you don't have that and you have to start from scratch and get the machine to actually discover the strategies for you. That area is much more treacherous, and you have to be really careful in how you do that.
Got it. So there are some famous, unnameable hedge funds that do focus on hiring people who don't have experience. And I presume, as you said, that they're simply trying to improve existing processes, models, and trading systems instead of trying to build something from the ground up.
Correct.
Well, that's a very important point. Now, I occasionally dip into the internet and Google search this, that, and the other when I have some time to kill, and I see that everyone wants to hire a machine learning graduate, PhD, expert, and so on. And so if I were sitting on the other side of the table, which I am occasionally, I would be scratching my head saying, how do I know what's real and what's fake? Fake is a strong word because there's always some level of confidence or some probability, but what's your vibe? What's your take on this whole question?
Yeah, I mean, that's the central question in machine learning, right? Where should you trust what it's telling you? And what's often overlooked about machine learning is that as a problem gets harder to predict, or as it gets noisier, right? So I look at the world in terms of sort of predictability spectrum, completely random to completely predictable. So all problems lie on this. As you move towards the randomness end of the spectrum, your models can become very unstable. Okay? And what that really means is that if you change your training set, the data on which you're going to build the model slightly, the model that's generated by the machine can actually change quite dramatically. Right? And so if that happens, you really shouldn't trust the machine. You should not trust that model. Right? So if you get like a high variance in what's generated, and we'll come back to what variance really means, right? But if you get this high variance in what the machine is generating, you shouldn't trust it, right? And that's kind of the core question that I focus on is, when should you trust the machine? Like, when should you trust the outputs of a machine? And my very simple answer to it is when there's stability, right? When there's a stability in the outputs, and so when you get to that point, you can say, all right, I think but that's a necessary condition, but not a sufficient one, right? You need stability to have some confidence that I'm not going to get a completely different set of trading decisions if I change my training data slightly, right? That should give you cause for discomfort.
Got it. I mean, one sort of more primitive way to think about it is to say, well, stability must be related to some kind of information criterion. I don't want to get too fancy, but if I have a really simple model and it kind of works, maybe it's automatically more stable. Where do you beat that?
Yeah, so
how do you beat that?
Yeah, exactly. I mean, you've gotten to the heart of it, which is, I said it's necessary but not sufficient, right? I mean, the simplest model could be you always bet the average, right? That's a simple model. It has zero variance, right? You will always do the same thing.
But
it probably isn't useful. It has heavy bias, right? And it probably isn't very useful. You're trying to sort of tease apart the structure in the space into like good longs, good shorts, and that means that you're introducing some level of complexity now, over and above that simple like bet the average model, right? And so you're now introducing a little bit of complexity for more predictability, and you might now sacrifice some degree of explainability for that increased predictability that you get from the complexity.
Is that trade-off the art of this business, or is it something that you can quantify in some way?
You always want to quantify something like that. How successfully you can do it is, of course, questionable, but it is something one should be able to, or at least measure parts of it, right? I mean, complexity for sure, right? You can specify how complex you want a model to be, how complex you want the machine to be able to, the complexity that you want it to be able to work with. So you can specify that. Depending on the form of your model, the parameters would, vary. You should be able to look at and analyze the variance of the model. And since I've already mentioned variance, let me just sketch it out. Like,
yes,
variance
please.
is two types. It's the variance in performance of the model, right? If you change the input set slightly, how widely does your output performance vary? And that's or rather the variance of the performance, how high is that? And the other part is your decisions. How do your decisions change as a function of small variations in your training set, right? Because if your decisions change a lot, that's also indicative of instability, even though your performance may not change.
Got it.
Right? And so those two elements is what I look at as variance. It's the variance in performance, and it's the variance in decisions.
I'm going to jump around a little bit and ask another question, which is, if I were a viewer of this show and I wasn't an expert in machine learning, and somebody sent me a big bank sell-side report showing the performance of a machine learning algo in a given market, let's say currencies or rates, what can I actually do with that? Is that totally useless?
Well, I mean, the question is it real or is it simulated? Like,
If all they
which
give me
it?
is the result.
But is it real? So it's actual trading performance, or is it, this is what I would have achieved
This
by...
is what I would have achieved.
Well,
which is
you can't
generally
really
what it
trust
is.
that. I mean, that's very difficult to trust just by looking at it, because you really have to sort of peel it apart and understand, what was the methodology, how many times did you look at the data, did you follow a process, and I think this is the first time I'm talking about process, so I'll get to that I'll explain what I mean by that. But did you follow a standard process in how you generated this set of outputs? As opposed to, well, let's try this. Oh, that doesn't work too well. Let's try something else. And oh, now it looks great, right? There's a famous saying that, I never saw a backtest I didn't like, right? I mean, how often have you seen a really poor backtest being marketed? Right? You don't.
I used to go to a series of talks where every talk, I'm actually cribbing off somebody else, ended with a graph that started at the lower left corner of the page, of the slide, and then wound up at the upper right corner.
Right. So
Yes.
yeah. So the short answer to that question is I wouldn't trust a backtest unless it were my own, and I know exactly what the assumptions were that went into it and the process that was followed. And one of my goals in life has actually been to get to the point where my backtests and reality are indistinguishable. Right? So my backtests don't look particularly impressive, but I trust that this is sort of what I'll achieve in reality. And by not too impressive, I mean that a backtest is a point estimate, right? It says your expected information ratio is 0.6. Right? Mm-hmm. And while we're talking about it, I want to say something about this, which is that I think anyone who's built strategies for some time knows that their realized performance sometimes bears very little resemblance to their backtest in the short term, and sometimes even in the long term, right?
Absolutely.
So your objective should be that they should mirror each other in the long term, right? In the short term, there's a lot of noise, things are really unpredictable, but in the long term, your backtests in reality should really mirror each other. That would be an indication that you've got a robust process and that you have the right set of complexity in your model, if you can get to that point. But that's
Okay, that's a good point. Now, debunk this idea. I knew a guy once, and he had a model that traded various equity sectors. It wasn't a machine learning model, mind you, but it did various things that would be now commonly known, factor modeling, this, that, and the other. And every now and again, he'd have a period of underperformance. So he traded 10 sectors, whatever. And he would gleefully call people up and say, oh, I've improved my system by throwing out the sector that didn't work, where the model didn't work.
right.
That seems a bit overly greedy in the language of algorithms. What do you find are the dynamics of the algorithms or the systems that you look at? And do you just throw out a model that doesn't work well for a while? Or do you believe that there's some regime dependence that may make it valid at some point in the future?
This question used to drive me crazy before I got to the point where I developed a process for generating my strategies. Because I started using machine learning in the 90s, but for the first 10 years or so, a little, maybe 12 years, the models I created were human curated. Right? So I'd look at the outputs of the machine learning algorithm, and then I would say, well, let me reduce the complexity here, let me round it off here, let me do this, like make all these changes, and it would be a human curated model. And I found that over time, there was generally a sort of degradation in performance, right? I mean, it didn't go smoothly down, it would kind of go like that, right? And every time it went like that, I'd think, oh, it's working again, and then it would go like that, right? So I just realized, and this is, common knowledge in the theory of finance, that humans just tend to be exceptionally poor at making decisions about timing and direction, and I was no better than that, right? So it was really a vexing problem where every month I'd have to make a decision as to which models to field and which ones to put away and how much risk to give them, right?
Okay.
And so even with optimization, it didn't really make it easy because I had to make these decisions. And then I figured...
But that branches in two directions.
It does, right? And my initial direction was, well, let's just use a mean variance optimization approach, and the models that have been performing poorly will automatically get dropped out because their expectation is low or negative, right? But that had its own set of issues, which is that your risk exposure could then swing around like crazy because all your equity models are doing well and your fixed income aren't.
Exactly.
Right? And so that has its own set of problems. So that was not the solution. But what I finally converged on as a solution was not to use optimization, but actually develop a process. And that where at regular intervals after you've accumulated more data, right, you keep accumulating data, and as you accumulate more data, you learn from that additional data and you retrain. And so to me, that was a much more graceful way of dealing with alpha decay, because you're saying, well, I'm going to follow a process, and I realize that the world changes, and I'm just going to keep incorporating more and more of the world, the data, into my process. And as long as I trust my process, I should trust the outputs that emerge from that process. So that was my way of dealing with, this issue of alpha decay and, what do I do? And what it made me realize is that you need two things. You need ideas, but you also need a process. And it's those two things together that make up a strategy. That is, without a process, you kind of are groping and probing and exploring, but you don't have a firm criterion for what you should believe.
Yes.
Which is what a process gives you.
Well, I don't get worried that much in the markets, but what does worry me particularly is this tendency that we've had since 2012, let's say, of incredibly quiet markets. So on the one hand, I know this sounds naive, you've seen a huge increase in the amount of data. You've seen Moore's law, or some super linear growth in computational power and so on. And yet the data set it could be argued that the data set that's been collected over these years is not all that rich, because markets have been artificially in zombie land, or whatever it's called. Zombification is the word. And if the regime changed, the machines that are learning gradually as the data comes in. So you can think of things, again, to use a fancy phrase, in kind of a Bayesian mindset where you have an inference engine, it's learning all this stuff. I've met Vasant 10 times, the 11th time he's rude to me or I'm rude to him, let's say. But it doesn't make me revise my opinion of him that quickly because I have this huge aggregation of prior experience. Now, if all of these inference engines or learning algos are loading on the past 3 years, 5 years, even 8 years, who's to say they won't be exposed in the next crisis? How do you account for that? How do you account for breakpoints, discontinuities, and the fact that everyone is probably chasing, at some course level, similar trades?
Yeah, you're getting at a really interesting question, and this is where sort of the human input or the creativity comes into the picture as part of the modeling process. Right? What you're really saying is that what we've observed is sort of one realization out of many possible realizations of reality, right? And so we've just observed this one thing, and the one thing we've observed is markets during a period of declining rates, right? Now, what you should really be doing also is looking at markets during periods of rising rates, right? So you go to, let's say, to 1994, and you go to 1997, and you go to 2004, right? Where, you've actually had periods where the Fed was tightening, right? So you need to exercise some sort of human oversight. And by the way, this could be also part of your process, right? Is that you need to exercise some oversight in terms of how you're going to guide the machine, or how you let the machine sort of do its thing, right? And you're right, if you just give it a period of declining rates, it'll just tell you should have been long this whole time, right? Being long bonds would have been awesome, right?
Absolutely.
But that doesn't mean being long bonds going forward will be awesome, right? It may not, right? It's not known. I mean, rates go to zero, sure, it'll be an awesome trade. But if rates remain where they are, and I think for the last 4 or 5 years, all the experts have been saying rates would go up, but they haven't, right? They've kind of gone up, but they've gone back down, right? They've kind of remained pretty much where they were like several years ago, give or take, right? It's hard to sort of point to like.
And this year they've been going down like no tomorrow. So
right, but occasionally they've gone up as well, right?
Yes.
But you're right. So this year has been largely again declining rates. And this is what you need to account for when you do your modeling is, are you just going to ignore those periods of rising rates? That would probably be unwise, right? So you do want periods in your training set to the extent possible that do give you that balance of potentially long and short trades.
But how do you conceptualize that? Because one could argue, as I would, that the credit cycle is part of life. It's part of markets. It can never be erased. Central banks can try and erase it, but that will just simply prolong the cycle and make it more exaggerated and so on. But one could also argue that in 1994 and 1997, structurally markets were quite different. There was much less impact of computers trading. ETFs hadn't blossomed or polluted the landscape, depending on your view. So structurally, the markets were quite different. How would you discount a period which richens your data set, but which is either old or perhaps not so reflective of the current dynamics?
I don't think you can discount your data set. I think you have to include as many periods as possible of different types of regimes. And now the question is, what do you really mean by a regime? And you could say, well, a period of declining rates is a regime, right? A period of increasing rates is a different kind of regime. So you need to incorporate different types of regimes into your training data. The other question you're raising is a really hard one about structural differences, because while you're right that structurally the factors impacting the market today are completely different from those in the 90s or even 10 years ago. But for people like us who work with prices, the sort of implicit assumption you're really making is, I don't care what the drivers are, right? They show up as these indicators of fear and greed, or whatever you want to call them, volatility, trend, whatever, right? So it's those exogenous factors that are making their presence felt in terms of these things you're measuring, and you're saying, I can't get into the causes and sort of analyze the structural properties of these different markets, because then I've got nothing to work with, right? Then I've got
but that's a key point. You're saying that the fact that you're using ML on price data is significantly different in terms of the richness of your historical data set from someone who might say, well, I use satellite images,
right,
or I use shipping data,
yeah,
or I use
okay, yes.
How would you address that for someone who's thinking about that and isn't sure what the relative importance of each
right
instance?
So I'm glad you brought that up, because one of the things that you need with machine learning methods is lots of data, right? And if your data frequency, the lower the frequency, the less you're able to learn, the less faith you'll have in something that you come up with, because you've only seen so many instances of something, right? So using monthly data, it's fine using monthly data, but there's a limited amount of action you can get with that, right? You just don't have enough instances. The denser your data set becomes, the better off you are, which is why you do so much better at sort of shorter trading frequencies. Like higher frequency trading is already machine-based, right? Humans don't stand a chance there, right? That's already been taken over by machines for good reason. Longer term investing, there's no scope for machine learning because there's not enough data there, right? That's sort of Warren Buffett kind of investing with periods of, holding periods of years, right? You don't have enough data for that. So the real sweet spot for machine learning is in the denser parts of the price space, which is intraday, daily kinds of data. When you start going away, less frequently than daily, it just starts becoming problematic. You just don't have enough data to learn anything from reliably.
Well, but let's try an analogy that confuses me, that's maybe contradicts this, but maybe doesn't, which is, think of credit card transactions. Maybe 1 out of 10,000 or 20,000 transactions are fraudulent. So the instances where you actually have a fraudulent transaction are very low. Therefore, you can get a great prediction in terms of accuracy by just saying every transaction is valid.
Correct.
So you're dealing with a very thin data set, even though there's a lot of time, there are lots of transactions.
Yeah.
You're dealing with stuff that doesn't happen that often within that data set. Is that an issue for you as well? So for example, let's say markets were going up in a straight line, or bonds were going up in a straight line.
Yeah.
Is it hard to develop a bond shorting or an equity shorting machine learning algo?
But not for that reason, right? So
Okay.
the case that you're bringing up is something occurs very infrequently. So the base rate.
Yes,
that's what it's called. The base rate is very low. The base rate is 1% or 1/10%, right? But that's the class you're interested in predicting, right? You're not interested in predicting non-fraud. You're interested in predicting fraud, right? So to say that my model is 99% accurate if I just predict everything is non-fraud is useless, right? So so you're bringing up an interesting point, which is that predictive accuracy is not what you're aiming for when it comes to the minority class, like when it comes to predicting things that are infrequent. Right. But I didn't finish answering your previous question, which is that
I'll keep rolling on that one.
Well, yeah, so why is it so hard to get good shorts, like with let's say the S&P or bonds, and that's not because the base rate is low, right? Which is, let's say, fraudulent transactions are they happen 1% or 1/10 of the percent of the time, whereas the S&P 500 actually goes down 46 or 47% of the time, right? So you actually do have a fair amount of days where the market goes down. But it's still hard to make that prediction because the problem is so noisy, right? That the machine just has this tendency to amplify its long bias.
Got
Right?
it.
So that's the reason why it's hard, because the problem is noisy, there's very little signal, right? So let's take the extreme case, right? So the extreme case would be there's no signal in the problem, right? You should always be long, right? Your
There's
output,
a premium, so.
Right, so there's a premium, right? So your output will be I'm always long, right? Even though the actual distribution is quite wide, right?
So people are behaving very rationally nowadays by that metric.
They are indeed.
If they have no signal.
Correct, right? So if there's no signal, then what the hell? Just bet the mean, right? But
Yeah.
as you get more signal into the problem, your predicted distribution begins to mirror the actual distribution, right? So in the case of like complete perfect signal, your predictions are exactly the same as the actuals, and your two distributions look alike, right? In that extreme case, on the complete predictability side. On the completely random case, your predicted distribution becomes a line. You always make the same prediction, right? So think of anything else in between as a situation where your predicted distribution is much narrower than the actual, and that's because of the noise in the problem, right? So the machine's not going to stick its head out and say, tomorrow's going to be a big up day, right? Because chances are it'll be wrong, or tomorrow's going to be a big down day. Chances are it'll be wrong.
So you're saying that formulating the problem in kind of a Nassim Taleb sense doesn't really fly. In other words,
No, it doesn't.
Instead of saying that your minority class is the S&P goes down one day, saying that it goes down by 2 or 3 standard deviations. Or
Yeah, you
more
want to
in
predict
one day.
the magnitude is important.
Got it. But those are pretty rare.
Those are pretty rare, which is why you don't predict them, right? The machine isn't going to predict that tomorrow is going to be down 3% day, because chances are it'll be wrong. Like, it'll predict the mean.
Okay, well, I'll ask a simple-minded question there then, which is that we've seen that systematic traders, not machine learning-based traders, but systematic traders had a real problem in August 2007. There was a quant crisis.
The equity long short.
The equity
yeah.
long short guys. Now, they had the freedom, the ones who did relatively well in some cases, had the freedom to turn one knob,
Yeah.
which said, I'm getting out.
Right.
My model's not working.
Yeah.
So I'm not a human intervention trader,
Yeah.
but I can shut the thing off.
Yeah.
Is that consistent with your view, or is it?
You always have to be able to do that.
You have to have that option.
You have to have that option.
And is that
when Fukushima happened, we stopped trading the Nikkei and the JGB. It was like, we have no idea, what's going to happen in Japan. Just turn those models off.
Got it.
So acts of God, rare events where that the risks are elevated and this is a complete crapshoot. That there's no way you could have learned anything useful that'll apply in that scenario. You may get lucky, you may get unlucky. Chances are you should just turn it off and get out until normalcy returns, which is not easy to determine, but that would be humanly the right thing to do.
I recall reading somewhere that George Soros his back would hurt if he was losing too much money and he didn't know why. So he'd cut his positions. I don't know if that's true or just fantasy on my part. Is that kind of the analog here, where you don't want humans to intervene with everything or even much of everything, but at some point you should have the right to just reduce exposure, cut your losses, analyze everything, and then get back into.
You should, and I tell my investors that as well. We are systematic, and we always sort of follow the machine, but there are situations that can happen, every few years. And these things shouldn't be happening every few days or months, because that means you're just interfering too much. But on average, we've had a few cases. Fukushima was one. The taper tantrum was another one, where it just seemed, that this was something new, right? So you have to sort of make that determination, but it's not easy, right? And that is something that we'll occasionally talk about and say, does this qualify as something just completely different? And you want to, most of the time, be able to say no, but every once in a while, something is different, and you should have the right to just turn it off.
What constitutes something being different, though? Let's say that stocks and bonds started going down together. Is that different enough?
No, that's just, that could be just liquidation, right? Just people just getting out, and there's massive liquidation going on. You could say that this seems like unusually heavy liquidation. I don't want to take the risk, right? Now, how do I define that criterion? I don't know, right? That's kind of, if I could, then it would have been part of my algorithm, right? So that's one of those things where you say, I don't know. I haven't enumerated all possible states of the world or possibilities here, but as a human being, presumably I have the intelligence to recognize one of these when it occurs.
Is a crude analogy that machines don't feel emotion, so I would never trade. I might trade badly, but I'd never trade 1,000,000 contracts instead of 1,000. Whereas a machine, barring the appropriate filter, which naturally, in all likelihood, would be in place, wouldn't see a difference. So there's some in extremes, humans have some override capability that perhaps machines don't. Is that what we're sort of agreeing upon here, or is that too simplistic?
No, I think that's fair. I mean, a machine by itself will only turn itself off if you actually told it. If the VIX goes above 40, just turn off. Right? I mean, that, you could specify that as a rule and say, well, that to me that means that the world is weird, right? The VIX is above 40, or you can define those things. But there are other things where you say, I don't know, I'll just have to wait and see, because the future is always new. It's never exactly like the past, even though it might rhyme with it, as you've once noted. But if it's sufficiently different, then and it's just something that's weird and looks treacherous, then you have to make that decision to turn it off. So nothing is always 100% systematic.
Now, before I get too depressing about this, you've been doing this for many years, well over 10 years, running your AQT system. If someone wanted to do the same thing today, and they had a decent amount of money bankrolling the thing, but they had no experience, what barrier to entry would they face? What things have you learned that they wouldn't know, they'd have to learn the hard way, that significantly make a system run by somebody like you more robust?
It boils down to experience.
What specifically have you learned?
Making mistakes. It's important to make mistakes.
Any specific kinds? Sizing positions?
I mean, where do I start? This could be a really long conversation if I get into all the mistakes I've made, which probably would not be a good thing. But yeah, you learn through your mistakes. And in a domain like this, you can make lots of mistakes because it's treacherous. It's a noisy kind of problem. There's a famous Richard Feynman quote, right? The easiest person to fool is yourself. So you have to be really careful to not fool yourself. And there is a tendency for us to want to believe in things, that something works. And that can be dangerous because you want to believe something. We desperately want to believe that stuff works. And so every bone in your body should be telling you to figure out what's wrong with something that seems to work, because most things should not work. And so if you see stuff that works, you really ought to question it, 10 times as hard, because chances are there's something wrong there. And that's been a great learning experience for me, to get to the point where you're sort of, where you believe something works and you find, oh, there's a problem with that. And the problem can be a methodological one, right? Maybe there was part of your process that was flawed. Maybe you aren't taking care of outliers properly. Maybe your complexity level is too high. Or maybe you're not just taking some reality of the market into account, right? So it's a combination of just experience in terms of market knowledge and just seeing how markets behave. Because unless you feel the pain and the pleasure from actually trading, it's all hypothetical, right? And that gets me back to that backtest thing earlier, right? And the backtest, it looks cool, right? But did you feel the pain when you went through that 40% drawdown? Like, what did it feel like, when you were on that slippery slope with 2 left feet, right? Completely different from a backtest. So I think there's really no substitute for experience. That doesn't mean you can't get lucky, right? You can get lucky and, hit pay dirt. But I wouldn't count on that.
There's been a kind of an elephant in the room recently, which is whether it's the short-term financing markets, the repo markets, or whatever, or anything to do with a short-term credit facility in the markets. That seems that it has the potential to upset all strategies that rely on leverage. How would you address that sort of issue as someone who is nearly purely systematic? Is that something that you have to factor in? Do you simply lower your leverage a bit below where you think it should be? Do you have a dynamic way to account for it over time? Do you look at spreads? Do you look at repo spreads and things like that?
Not in futures markets, where your leverage is sort of inherent and more than you need, right? I mean, in futures markets, we're actually trying to damp down the leverage because you can lever up to the hilt and really get into trouble. So in those markets, you're really kind of levering down to your desired level of volatility. And funding costs, they tend to arise more in the form of exchanges imposing, let's say, higher margins or stuff like that, right? That's where, your costs can increase. But that tends to be relatively rare, right? It's a silver market goes berserk and, they decide to impose limits or increase margins. It's those kinds
So
of
the
things.
basic argument is that the repo issues or whatever that occurred in
Not
September
that- yeah.
are more impacting the cash bond market
Correct.
than the markets that a CTA type structure would trade.
That's right.
Got it. Well, I guess an important question for a lot of viewers or participants like myself is, has machine learning been oversold? And if so, where? And how can someone like you step in and help to educate people who want to know more about the space?
Yeah, great question. I mean, I think it has been oversold. I think some of it is just sort of this effect from the fact that it works in other areas. It's making its way into navigation, into language, into search, right? So it's machine learning sort of become a important part of our lives, and so people just assume that, hey, let's do it in finance as well. But it's harder to do in finance because it's a noisier kind of problem, and it's not as easy to apply it to finance as it is to, let's say, a domain that has a lot of structure in it. So in that sense, I think it's been oversold. It's not like you just put in data and magic appears at the other end. There's a lot of care that has to go into how you formulate the problem, how you curate the data, whether you have a process in place.
Wasn't one of the early validations of machine learning or AI in general just the human eye? In other words, you'd get fuzzy images from telescopes and so on, and then you could run some algo on them, which would see a huge number of images and then make sense of what this noisy image should look like, and then it would clear it up, and the human eye could say, oh, that's a real license plate. I can read the number, whereas it was completely fuzzy before. But doesn't that raise the issue that outliers, so if a camera takes a picture and it's a bit fuzzy here and there, the outliers should be smoothed out or removed, whereas in financial markets, those outliers are essential because they drive price action over the long term, or they drive compounded returns, more to the point, over the long term. How do you think that part of it has been oversold? Do you think there's too much smoothing going on and not enough feature extraction?
I don't know whether I would state it like that or at that level of detail. I think that's just one piece of the problem.
I've extracted too many features.
I think it's an important part of the problem. This aspect of like how do you deal with outliers in, let's say, vision versus finance, and that's actually a whole conversation in itself that we could have, right? That's a very meaty kind of an area. But I think it's that and lots of other things, right? The lack of structure in the problem that just make finance infinitely more challenging than, let's say, applying it to vision, where there's so much structure to the problem.
Stationarity as well.
Stationarity and an unambiguous relationship between inputs and outputs. Like, however complex they may be, at the end of the day, people can say, well, that's a cat, and that's a dog, and that's a 9, right? Unless that 9 kind of is so fuzzified that even humans can't tell, in which case a machine can't tell, right? But for the training data where it's unambiguous, there's an unambiguous mapping between inputs and outputs, that's a great problem for machine learning, right? Whereas in finance, there isn't that unambiguous mapping, right? You can have the same X with 2 different Ys. By the same X, I mean the same set of market conditions as you specified them, but the outcomes are completely different, right? So that's what noise really means in finance. It's the same market state, but the outcomes are different. right? Whereas in vision, it's a different kind of problem. So if you take someone who's worked in vision, he says, all right, apply it in finance, it's not obvious that those ideas really carry over. It might actually get you into trouble. You may be overly optimistic about what you can achieve.
Well, it's been wonderful having Vasant on the air. I was looking forward to this, and I'll leave it to him to sum up.
It's been a pleasure. I've really enjoyed it. Great set of questions, and thank you.